what I'm trying to say here is hold on. The only certainty we have now in terms of stability of your wealth, I would say maybe a little bit of cash, but ultimately just gold, hard gold, hard silver, physical silver. I think we're going into turbulent times. Saturday, April 5th, 2025, Maneco 64, home of alternative economics and contrarian views. Well, today we're going to look at an ominous sign that I think we saw yesterday, and that's U.S. 10-year Treasury yield actually spiking higher in the last half of the day, last few hours of trading, while the stock market continued to crash. Things are getting worse. We saw China yesterday retaliate with 34% tariffs. That happened after I posted my video, so things got really chaotic in the markets. Before I start today, though, I'd like to let you know, because Clive Thompson wasn't on yesterday morning. I usually do a chat with Clive on a Friday, and it would have been great to have him on. But unfortunately, he's had a health problem, nothing serious, but he's trying to rest. And I was going to talk to him this morning, but he thinks it's better for him to try to recover for Sunday, for tomorrow's live stream. So I just wanted to put that out there. He hasn't disappeared. And the other thing I'd like to say is thank you for all the interest in the channel, for all the new subscribers and the existing subscribers. And so for those of you who don't know, I was a government bond futures and options broker for like 20 years. And I also worked in the cash market, not futures market, in government bonds before I started in the futures market. So I was like a bond specialist, and I follow these markets very closely. And they are the most important markets out there. They set the tone for all asset classes, especially the 10-year Treasury yield, or treasuries in general. And why is that? Well, because in the fiat world, and that's something I've learned, of course, in the last 25 years. Prior to that, I used to think that, yes, like a lot of people still think treasuries are the safest place to be. They're risk-free. They have a risk-free rate of return. And it's shocking that still a lot of people believe that, and that they believe that when push comes to shove, when things might get even worse next week or the week after, people are going to rush to treasuries. In my opinion, they couldn't be more wrong, and that's what I want to touch upon today as well. And I want to show you as well that what happened yesterday in the last few hours of trading, I'm sure not many people noticed it, but I noticed it because that's the way I am. I follow these things really closely because they're really important. They're really important indicators. And once you see something that doesn't add up, it flashes red lights all over for me. Before, though, I look into this discrepancy I saw yesterday, which could be pointing to trouble ahead, just wanted to touch upon John Exter and John Exter's inverted pyramid, because it's really important that you understand what treasuries really are, or what they have been since August 15th, 1971. So John Exter, if you and it's not Exeter, it's John Exter. If you Google him, you will find him on Wikipedia, and it says here, John Exter was an American economist, member of the Board of Governors of the United States Federal Reserve System, and founder of the Central Bank of Sri Lanka. He's also known for creating Exter's Pyramid. So let's jump to Exter's Pyramid and why that is important. Well, it says here, Exter is known for creating the pyramid, known as Exter's Golden Pyramid, Exter's Inverted Pyramid, for visualizing the organization of asset classes in terms of risk and size. In Exter's scheme, gold forms the small base of most reliable value. Yes, gold, and I would add silver as well to that base, even though silver can be very volatile in the crisis. And asset classes on progressively higher levels are more risky. The larger size of asset classes at higher levels is representative of higher total worldwide notional value of those assets. While Exter's original pyramid placed third world debt at the top, today's derivatives hold this dubious honor. And notice how the higher the assets are, the more there is of it, which is worrying. And why is that? Well, because it's more leveraged. It's more leveraged not just on gold, but on paper money, on government bonds and treasury bills, and so on and so forth. And it's one of the reasons, if you strip out gold from this pyramid, and for Keynesians in the mainstream, gold is not even part of their equations. So that's why they think paper money and government bonds are the safest place to be. And you don't have to believe me, but my opinion and my money, my savings is dependent on this being right. And I think it is 110% right. When push comes to shove, people are not going to rush to paper treasuries. Why is that? Well, because since Nixon closed the gold window on August 15th, 1971, the dollar has been an IOU nothing. And that's not me saying it. It was John Exter. He wrote an article about this back in 1972. I'm going to try to find a link and put it below in the description and you can read it. So, and one of the reasons he brought up this inverted pyramid is because, in his opinion, when this IOU nothing fiat dollar imploded, when the whole system collapsed, all the liquidity would flow to the bottom of the pyramid where gold and silver are. Yes, there's a lot to flow through government bonds, treasury bills, and even paper money, but ultimately gold and silver are the only parts of the pyramid that will stand because there's no counterparty risk to them. Of course, that's only if you hold physical gold and silver. Paper assets in gold and silver ETFs and anything else, LBMA, allocated promissory notes, COMEX, they're all at the top of the pyramid, actually. They are derivatives. So that's why we see this volatility in the price of gold and silver. But if you try to go out there and buy real physical gold and silver in quantity, there's going to be a delay and the premiums are starting to move higher. That's what I've heard from a good source, a good friend of mine who runs actually a family office in the Bahamas. He's been hearing, and he works a lot with the gold sector, mining, physical gold, and apparently there's a panic to buy physical gold out there for sovereign wealth funds and also central banks. They're concerned that there will be a failure to deliver through the derivatives market, be that the COMEX or the LBMA. You might not agree with me. You might say LBMA is a physical market, but not 100%. It's a promissory note. It's a derivative, for OTC derivative. That's what it is. It's a forwards market mainly. So yes, we've seen a lot of volatility in gold, especially in silver. We've fallen back below 30 in silver. Gold just held above 3,000. But to put it into context, I wanted to bring up this post by Eric Young, or King Kong 9888, and I should have him on soon, hopefully, to talk about what's going on. But he posted this recently, I think it was yesterday or today. He said in March 2020, gold dumped from around 1,600, and actually, it was actually just above 1,700 that gold dumped from to 1,450. So it was more than a 10% drop. And that's when all hell was breaking loose. Of course, in March 2020, the stock market dropped like over 30%, I think, in a week. But he notes that a lot of the miners dumped 80%. So the miners, even though they have come off, they haven't dumped 80%. So he says in today's term, that would be the equivalent of gold dumping to 2,800 with miners devastated. Of course, that hasn't happened. And he says, I think silver dumped from 18 to 12. Yeah, around 18, 20 to 12 back in March 2020. That would have been equivalent of silver dumping to around 23 in today's term. So yes, a lot of people over the years worry about these events where there's a stock market crash, whether gold and silver are gonna crash along with it. Yeah, and they do, and we've seen in the last few days that they have. But at the same time, I mean, yesterday gold, spot gold got up to like 31.30. It did finish, I think, around 30.35. I'm not sure what the closing price was. What I'm trying to say here is, and I've said this many times, I have a series of videos, it might even be a playlist, I don't remember, that you need to hold on to your gold and silver for dear life. And the reason I say that is because of Exeter's pyramid. So let's go back to what I said in the beginning of the video. What is the discrepancy that I'm not really liking here? Well, not liking in terms that I think it could be bad news for the Trump administration and the Treasury Secretary Bessent. Well, it's this one here, these two charts. On the left-hand side, you've got the 1 hour U.S. Treasury 10-year yield. And what you need to know in the bond market is when yields go up, the price of the bond goes down. So it's a bad thing. And I listened to Scott Bessent. He had an hour-long interview with Tucker Carlson. And he basically showed his cards. He said this is the most important indicator for him, the 10-year Treasury yield. He said every basis point, so let's say from 4.0 to 4.01, every basis point is 1 billion in savings on average for the Treasury in terms of refinancing and paying interest, doing interest payments. So he said he was concerned when he was nominated on January 28th because this yield was approaching 5%. I think it got up to like 4.8. So we know that we know where he's going to be sweating. He's going to be sweating if these yields rise and go towards 5%. He's going to be calm and collected if they keep falling. But some people have argued, and I even think President Trump posted something on Truth Social that someone made a video saying that he's letting the stock market collapse to bring Treasury yields down, and he posted that. So we can safely say this is what they're trying to do. They're trying to force maybe the Fed also to cut rates. But I saw that Fed Chairman Powell wasn't very helpful yesterday. He said, yes, tariffs are going to put pressure on inflation, which for them makes sense. For me, it doesn't, because inflation is a monetary phenomenon. Tariffs raise prices, but be as it may, he said, yeah, we could have a slowdown and higher prices or inflation. And I think it's one of the reasons why the Treasury yield, even though it dumped to like 386 almost, the 10-year, rebounded in the last half of the day, all the way back up to 4. And you can see that it closed at 3.998. So that I wondered if Mr. Besant, who has access to the plunge protection team, to the exchange stabilization fund, I wonder if at the end of the day he just bought some 10 years to keep the yields below 4. But that's not the point. My point is that I just said that Trump agreed with this clip that he posted on Truth Social, that they don't care if the stock market goes down right now, because they want Treasury yields to go lower in order for the Treasury to save on its interest bill. They've got I think $9 trillion to roll over this year of old Treasuries, which is huge. And I'm going to come to that in a minute as it pertains to foreigners as well. But as you can see, the right-hand chart is the Dow. It's called Wall Street on my system, but it closed basically near the lows of the day. I think it was down over 2,000 points. So it was a bit of a bloody Friday, you could say. What's going to happen on Sunday? Could Treasury yields be pointing to a rebound in the stock market? That's possible. But if stock markets continue to dump and yields continue to rise, 10-year yields, that's a really bad sign. So what I want to show you now is some charts of gold versus first the 10-year Treasury note. That's in terms of prices. It's a constant maturity Treasury note, because the Treasury issues 10-year notes every few months, new ones, and then they become old. They become 9 years or 8 years. So this is a constant maturity of 10-year note. And if you look back here, since the beginning of the century, gold has been in a bull market versus Treasuries. Gold has been the place to be. Yes, we had a long consolidation from 2011 up until last year in 2024, when gold broke out, not just versus the dollar, but versus 10-year dollar, you could call it. That's all it is. And yes, gold has dropped back a little bit this week versus the 10-year Treasury, but you can see the trend is higher, and the breakout of this consolidation is very bullish, just like the price of gold breaking out last year has been very bullish, and I think that's going to continue. The other gold ratio I wanted to show you is the Dow gold ratio, and I think that's another very important ratio. Pierre Lassonde, who's like a Hall of Famer mining investor, founder of Franco-Nevada royalty company, I agree with him. He says this ratio will go back to 1-to-1. I don't know at what price, but it will mean that you'll be able to buy one Dow Jones Industrial Average Index for 1 ounce of gold. And as you can see here, this is a weekly chart, and we closed on the lows of the week. So the Dow crashed versus gold as well. and it's very close to the low that we saw actually in March 2020, despite the correction in gold that we saw back in 2020. Gold, the Dow actually crashed even more. So that's what I'm trying to show you here. It's all relative, and I think the trends, as you've seen from these last two charts, the gold versus the constant maturity 10-year Treasury and Dow versus gold, those trends are set. They are set here now. I think, yeah, gold is going to continue to outperform the stock market and the bond market. Yes, there's going to be corrections along the way, but the long-term trend is definitely set in the advantage of gold and silver as well. I know the gold-silver ratio went up above 100 yesterday, but I would say that's just another opportunity to buy physical silver, not ETFs, of course. And the other thing I wanted to talk about is the interview with Tucker Carlson that Scott Bessent had. Talks about what President Trump is trying to do here with these tariffs. And I think it's going to backfire on them, because if you really think about it, it was the American elite who set up globalization, who set up the Bretton Woods system, who closed the gold window, who set up the petrodollar system. They've been the ones who built up this system, and now President Trump is blaming foreigners for ripping America off. Yes, on the surface, that's what it looks like, but he should be blaming his predecessors and the American elite who put America in this position. And why am I talking about this? Well, because I think it's very naive to think that by wrecking the whole system the way it's being wrecked right now with these tariffs is going to encourage foreigners to come and invest trillions in America, or build their factories in America, or continue to buy treasuries, right? So I'm afraid the Trump administration, they're only looking at the numbers. If we do this here and there, if we let the market crash, we bring yields down, we've put 30%, 50% tariffs, we're going to get this and this. It's going to, yes, the numbers always look, on the surface, things look like they're going to work. But what they've failed to consider, in my opinion, is the mental, the reaction of foreigners to all of this. It's not going to be a straight commercial reaction of numbers and percentages. It's going to be of retaliation, and it's going to be they're going to boycott the United States. Why should they buy treasuries? Why should they invest in the U.S. when an administration like Trump's in 5 years' time could come and say, or 3 years, we're going to take over your factories in the U.S. because you've been doing this and this. They can use any excuse. So what I'm trying to say here is hold on. The only certainty we have now in terms of stability of your wealth, I would say maybe a little bit of cash, but ultimately just gold, hard gold, hard silver, physical silver. I think we're going into turbulent times, and treasuries are not the place to be. They could freeze foreigners' treasury accounts too. That's been done. The Swiss had their treasuries frozen during World War II. So there you go. And I'm just observing from afar. I'm in the UK. I was born in Brazil. I did go to university in the States. I'm just being neutral here and telling you what I see. I'm not taking sides. I'm just trying to work out how this is going to affect our bottom lines. So with that, I'm going to wish you all a very good weekend. Take care. Bye.